Common sense. From loose change to big change. The recent escalation between Iran and Israel, with airstrikes and missile attacks, may seem far away for most Americans. But the shockwaves are already reaching the United States, affecting our economy and daily lives. This conflict is not just a distant headline. Its impact will be felt at the gas pump, in our wallets, and in the stability of our financial markets. The main reason? Oil. The Middle East is the world's key oil hub, and instability there means economic uncertainty everywhere. Recent attacks have already pushed crude oil prices from the low 60s to over $76 per barrel. Higher oil prices mean higher costs for fuel, goods, and manufacturing, raising the cost of living for everyone. Petroleum is deeply embedded in the American economy, from transportation to everyday products. The U.S. is not just a bystander. As Israel's ally and Iran's adversary, America is deeply involved. The risk of direct U.S. involvement could turn a regional conflict into a global economic crisis. For American families, this isn't just foreign policy, it's about household budgets and job security. Rising prices, volatile markets, and job uncertainty are likely to be the real impact at home. In our interconnected world, no major conflict truly stays far away. At the heart of the global oil economy lies a narrow strip of water known as the Strait of Hormuz. This choke point, only about 21 miles wide at its narrowest point, is the world's most important oil transit artery. Roughly 1/5 of the entire planet's daily oil supply passes through this strait, which is primarily controlled by Iran. This geographic reality gives Tehran tremendous leverage in any conflict. The threat of closing the strait, which Iranian ministers have already made if the United States enters the war, is a powerful economic weapon. Such a move would instantly choke off a massive portion of the world's oil exports, sending prices skyrocketing and creating a global energy crisis of a magnitude not seen in decades. Even without a full closure, the conflict is already making oil transport more expensive and dangerous. Insurance premiums for oil tankers navigating the Strait of Hormuz have surged by an astonishing 60% since the hostilities began. These costs are not absorbed by shipping companies. They are passed down the supply chain, first to refineries and then directly to consumers at the gas pump. Every time you fill your tank, you are now paying a risk premium associated with the conflict. Analysts at Barclays have warned that prices could climb to $85 per barrel if Iranian oil exports are merely halved, and could easily surpass $100 in a worst-case scenario involving a wider war and a blockade of the strait. This surge in oil prices acts as a hidden tax on the American economy. It's not just about the cost of gasoline, although that is the most visible effect. Higher fuel costs drive up the expense of transporting goods across the country, from fresh produce to electronics. Farmers pay more for the diesel to run their tractors, airlines face higher operational costs that translate into more expensive tickets, and manufacturing plants must absorb increased energy expenses. All of these added costs eventually find their way into the price tags of the products and services we buy every day, fueling a broader wave of inflation that erodes the purchasing power of every dollar a family earns. The situation creates a cycle of economic anxiety. As Americans see prices rise for essentials like fuel and food, consumer confidence begins to falter. People may cut back on discretionary spending, choosing to save money rather than dine out, travel, or make large purchases. This reduction in consumer activity can slow down the entire economy, as businesses see their sales decline and may become hesitant to hire new workers or invest in expansion. The instability in a narrow waterway on the other side of the world thus directly influences the financial decisions made in households and boardrooms all across the United States, demonstrating the fragile and interconnected nature of our global economic system. The uncertainty radiating from the Middle East has sent powerful tremors through global financial markets, prompting a classic flight to safety among investors. In times of geopolitical crisis, traders tend to sell off what they perceive as riskier assets. We are already seeing this play out as tech stocks, growth-oriented companies, and sectors directly impacted by travel and shipping such as airlines and logistics firms have experienced significant sell-offs. Investors are cashing out of these volatile sectors and moving their money into assets that are traditionally seen as safe havens during turmoil. This is why we've seen a corresponding surge in the value of defense contractors, energy companies, and precious metals like gold. This market volatility is more than just a headache for Wall Street, it directly impacts the retirement savings and investment portfolios of millions of Americans. The 401(k)s and IRAs that people depend on for their future are often heavily invested in the very stock market that is now shaking. Sudden downturns can erode years of savings, creating anxiety and forcing individuals to reconsider their financial plans. The psychological element is powerful. Fear of further losses can trigger panic selling, which in turn exacerbates market declines. Financial experts are advising clients to avoid emotional decisions and maintain a diversified portfolio, but staying calm is difficult when headlines are dominated by war and economic instability. As rising oil prices push up the cost of goods and services, the United States economy faces a growing threat of inflation. This is where the Federal Reserve enters the picture, facing a classic and difficult policy dilemma. The Fed's primary tool for combating inflation is raising interest rates, which makes borrowing money more expensive and tends to cool down the economy. However, with economic growth already showing signs of slowing due to existing trade tariffs and market uncertainty, raising rates now could risk tipping the economy into a recession. This creates a dangerous tightrope walk for policymakers. Fight inflation and risk choking growth, or support growth and risk letting inflation spiral out of control. This precarious situation raises the specter of stagflation, a toxic economic condition that combines high inflation with stagnant economic growth and rising unemployment. It's the worst of both worlds, where the cost of living goes up while job opportunities and wage growth decline. The Federal Reserve's recent decision to leave interest rates unchanged reflects this deep uncertainty. They are in a wait-and-see mode, hoping the conflict does not escalate further. But for American families and businesses, this period of indecision means preparing for sustained high prices and a potentially weaker job market, a direct economic consequence of geopolitical strife far from home. Section 4, the price of power, defense spending, national debt, and supply chain chaos. Direct or even indirect United States involvement in the Iran-Israel conflict carries a steep price tag, one that will be added to an already staggering national debt currently approaching $37 trillion. For context, the post-9/11 wars have cost the United States an estimated $8 trillion over 2 decades. Any new military engagement, whether through providing emergency aid to Israel or conducting direct military operations, would require a significant increase in defense spending. Congress would likely be called upon to approve massive supplemental budgets for the Pentagon, funneling billions of dollars into military hardware, troop deployment, and intelligence operations. This spending would undoubtedly benefit defense contractors like Lockheed Martin and Raytheon, but it would be paid for by the American public. This new financial burden would be financed either through higher taxes or, more likely, by issuing more government debt. Both options have serious consequences for the average citizen. Increased borrowing adds to the national debt, placing a greater strain on future generations and potentially leading to higher interest rates across the economy. If the government opts for a path that fuels inflation to manage its debt, it acts as a regressive tax, disproportionately harming low and middle-income families whose savings and wages lose value more quickly. The price of power is therefore not just a figure in a government ledger, it is a real cost passed on to taxpayers through various direct and indirect means. Beyond the direct costs of war, the conflict threatens to severely disrupt the intricate network of global trade and supply chains that modern economies depend on. The potential closure of the Strait of Hormuz is the most dramatic risk, as it would not only halt oil shipments, but also block the passage of countless other goods, from raw materials to finished products. However, even without a full closure, the increased risk in the region can cause shipping companies to reroute vessels, leading to significant delays and higher transportation costs. This creates bottlenecks and shortages for United States industries that rely on just-in-time delivery of parts and components. This disruption would feel eerily similar to the supply chain chaos experienced during the COVID-19 pandemic. American sectors like manufacturing, electronics, and even agriculture would face delays in receiving critical components, leading to production slowdowns and empty shelves. Companies with highly complex global supply chains, such as Apple or Tesla, would be particularly vulnerable. These shortages and increased logistical costs would ultimately be passed on to consumers in the form of higher prices and longer waits for products. A conflict in one of the world's most vital shipping lanes quickly becomes a problem for anyone trying to buy a car, a smartphone, or even certain groceries in the United States. Section 5. Navigating the storm, the dollar, investor psychology, and the importance of staying informed. During times of global crisis, a fascinating and somewhat counterintuitive phenomenon often occurs in currency markets. The United States dollar strengthens. Investors around the world, seeking a safe place to park their money, flock to assets denominated in dollars, which are backed by the world's largest economy and most stable political system. We have already seen this happen with the dollar gaining against other major currencies like the Japanese yen and the Swiss franc. However, the dollar's recent gains have been somewhat lower than past crises. It has not been able to break past the 3-year high, suggesting that the market has underlying concerns about the United States economy's long-term health. The immense fiscal pressure from a potential war, combined with existing trade tensions, is weighing on investor confidence. While a direct United States military intervention might initially push the dollar higher due to the flight to safety effect, the subsequent increase in national debt could eventually undermine its strength. The currency markets are therefore reflecting a complex reality. The dollar is the safest port in the current storm, but the storm itself is threatening to damage the port's foundations. This entire situation underscores the critical importance of investor psychology and the need for rational decision-making. Fear is a powerful motivator, and in volatile times it can drive markets more than economic fundamentals. The constant barrage of alarming headlines can lead to panic, causing people to sell at the bottom or make rash decisions that harm their long-term financial health. The wisest course of action, as advised by financial experts, is to remain calm, stick to a well-thought-out and diversified investment strategy, and base decisions on facts rather than fear. Understanding the mechanics of how geopolitical events affect the economy is a crucial tool for navigating these turbulent waters without succumbing to panic. Ultimately, the conflict between Iran and Israel is a powerful lesson in global interconnectedness. It demonstrates that political and military events thousands of miles away can have a direct and measurable impact on the financial well-being of every American. From the price of gasoline and groceries to the value of retirement accounts and the stability of the job market, the consequences are real and far-reaching. Staying informed is not just an exercise in civic duty, it is a matter of economic self-preservation. By understanding these connections, we can better anticipate the challenges ahead and make smarter, more resilient decisions for our families and our future. If you got value from this video, don't forget to hit the like button. Subscribe if you want more simplified breakdowns on investing, personal finance, and global economic trends, and join the journey from loose change to big change.